What's going on, everybody? This is Coach Wade, and today I want to answer another question that many investors eventually ask. Do you need bond index funds? Now, if you've been following this investing series, we spent a lot of time talking about stock index funds. We talked about the S&P 500 index fund, the total stock market index fund, and international index funds. Those investments focus on owning pieces of companies, but today we're going to talk about something different: bonds. Now, don't let the word bond scare you. They're actually much easier to understand than most people think. Let's start with this question. What is a bond? Think about it this way. When you buy a stock, you're buying a small ownership interest in a company. But when you buy a bond, you're generally lending money to a government, a corporation, or another organization that agrees to repay the loan according to the bond's terms. In return, the bond issuer typically pays interest to investors during the life of the bond. Then, if everything goes as expected, the principal is generally repaid when the bond reaches maturity. Now, most people don't go out and buy individual bonds. Instead, many investors choose bond index funds. A bond index fund invests in a large collection of bonds instead of just one. That means you can own hundreds or even thousands of different bonds through one investment. Just like stock index funds provide diversification among stocks, bond index funds provide diversification among bonds. Now, here's the next question. Why do people invest in bonds at all? After all, if stocks have historically provided higher long-term growth potential, why not just invest in stocks? Well, because investing isn't only about growth. It's about managing risk. Think about building a house. You don't only think about making it bigger, you also think about making it stronger. Many investors view bonds as one way to add stability to an overall investment portfolio. Now, let me be clear. That doesn't mean bonds never lose value. They can. Bond prices can rise and fall based on things like interest rates, economic conditions, and credit quality. But historically, bonds have often behaved differently than stocks during certain market conditions. That's one reason some investors include them as part of a diversified portfolio. Now, let's talk about something called asset allocation. That's just a fancy way of saying, how do you divide your investments? Some people have portfolios invested mostly in stocks. Some own a combination of stocks and bonds. Others include additional types of investments. Your asset allocation depends on many factors, such as your financial goals, your investment time horizon, and how comfortable you are with market ups and downs. For example, someone who is decades away from retirement may have a different investment mix than someone who plans to retire next year. Neither approach is automatically right or wrong. They're simply designed for different situations. Now, here's another question. Does every investor need bond index funds? The answer is not necessarily. Some investors choose to include bonds in their portfolios. Others may choose a different allocation based on their personal circumstances and long-term objectives. The important thing is understanding what bonds are designed to do and how they fit into your overall investment strategy. As I always say, you should understand what you own before you invest in it. Now, here's something else I like about bond index funds. They're simple. Instead of trying to research hundreds of individual bonds, you own a diversified collection through one investment, just like with stock index funds. You're letting the fund do the work of holding a broad basket of investments. Now, remember something important. Every investment involves risk. Stocks can go down, bonds can go down, markets change, interest rates change, the economy changes. That's normal. The goal isn't to eliminate risk. The goal is to build a financial plan that reflects your own goals and that you can stick with over the long term. As I teach in stage 4 of the 7 stages to financial independence, the wealth building zone, investing should always have a purpose. You're not investing because everyone else is. You're investing to prepare for your future, to build wealth over time, and to give yourself more financial options later in life. One of the biggest mistakes investors make is constantly changing direction. One year, everybody wants one investment. The next year, everybody wants something else. Successful investing usually isn't about chasing the newest trend. It's about staying committed to a well thought out plan. Here's what I want you to remember. A bond index fund allows you to invest in a diversified collection of bonds through a single investment. Bonds are generally designed to provide income and can play a different role in a portfolio than stocks. Whether bond index funds belong in your portfolio depends on financial goals, investment timelines, risk tolerance, and overall investment strategy. There isn't one investment that's right for everyone. There isn't one portfolio that fits every family. The key is understanding how each type of investment works and how it supports your long-term plan. I'm Coach Wade, and I believe investing doesn't have to be confusing. The more you learn, the more confident you become. The more confident you become, the better financial decisions you're likely to make. So keep learning, keep asking questions, stay focused on the long term, and remember, building wealth isn't about finding one perfect investment. It's about creating a solid plan, staying disciplined, and giving your money time to work for you. I'll see you in the next lesson.